not only new home construction continues, but let's keep building smaller and smaller homes so we can get more inside of a footprint. We can lower the price point because affordability can be got by lower prices, lower rates, higher wages. But if you actually build a product that is smaller, the price point is better. So let's put that out there as well. All righty, folks. Something I called this morning that I wanted to check in with Lance Lambert was what was going on with mortgage rates. This obviously happened after the fifth inflation reading that was hot. We've had a couple of CPIs, now a couple of PPIs, and a PCE all coming in hot. I guess that interest rate, 30-year mortgage rates would be over 7% by the end of day Friday. What say you, Mr. Lance Lambert? What's going on right now?
You nailed it. So the average 30-year fixed mortgage rate is measured by Mortgage News Daily 7.02, 2.73 spread. I'm guessing tomorrow's probably gets a little bit higher because I don't know if the mortgage rate's quite caught up to this 10-year jump. But yeah, we're back to a 7 handle.
So this is important because I think 7% is a psychological number now. I've been studying the consumer for 30 years. The consumer gets anchored on something. And I believe the consumer is anchored on 7. Over 7 bad, under 7 good. And I'm serious. 7.02 bad, 6.98 good. I mean, I believe it's that razor thin. And it'll be interesting to see if housing forecasts change. I think it's very likely that interest rates stay over 7% for months. Right? We've got inflation hotter than expected. The internals of inflation aren't great. We have a job market that's not deteriorating quickly. We've got a Fed meeting next week with the dot plots next week, Lance. I think the dot plots that come out Wednesday afternoon are going to shock people. And some of the Fed presidents are going to say rates are going to go higher, not lower. Last month, the Fed said nobody, or the last SOP dot plot, nobody said they're going up. I think we're going to have 3 or 4 Fed presidents say rates are going up, not down. And then I think a lot of people are going to change their forecasts. And it's just going to be another flat year. So I know I just threw a lot of stuff at you.
Throw out a word for you. I think what we're probably seeing right now, because we've been at this higher for longer now, and we're seeing some of like the people who were like, I'm not selling. And then some of the life events have kind of happened and we see new listings moving up a bit, nothing too crazy. I think the word is balancing. I think the housing market is getting balanced more.
Yes, we have to get here. We have to get to a normal housing market. And the only way to do this is rates stay at 7 and time. It's just, it's not fun. It's not sexy. But we need it. I would like nothing better than a normal housing market.
So we can have a year where, let's say active listings jumped 50%.
Okay.
We would still be down 15% from pre-pandemic levels. Because right now we're down 40%. And to get out of a 40% hole, I think you need like a 70% jump or something like that.
68 or something.
Yeah. So it's still not going to get us there. But you need that actives to be more balanced, right?
We absolutely do.
During the pandemic housing boom, there was active listings, but technically there wasn't.
No.
Anything that was anywhat decent. Yeah, I mean the lemons were selling super fast. Was just off the market. And when rates shot up, we saw some balancing, some inventory jump, but we still never made it back to a balanced housing market. And then you had the weird thing where couple markets made it back to balance, Phoenix and Vegas, and then tightened right back up once the iBuyers were passed through. So I think what we're kind of seeing is some balancing in the market as rates.
Yeah, and as the 54-year spreadsheet kind of shows, we've been here before in the early 80s. It takes years to kind of balance out. And I don't expect it to take a decade like it did last time, but it wouldn't shock me if it took 10 quarters, so a couple of years. We just got to get through this time period. The housing market's broken, and the only way you fix it is time and flat interest rates, in my opinion.
Time and make sure single family construction continues.
Good point.
time, yeah, that's the sweet spot. It's I think one thing that could be bad is if we had a hard landing and there was, because housing demand could get worse for a
Oh
bit.
yeah.
Builders would be pinched. And that's what we don't want to have. We don't want to have any drop off in single family construction because we've been in this nice place where, yeah, single family starts have come down a bit off the pandemic highs, and home sales are off the pandemic highs for new homes. But really, the number of single family homes being completed is still stayed very strong, right?
Yeah.
Because the build cycle has sped back up because the labor market's loosened enough, supply chains have loosened up a bit, so you continue to move that. But if we go through a period where there's a bit of an air pocket and that pulls back, that wouldn't be good. So I think affordability improved here is going to take it's going to take time. We've gotten into a tough spot,
Yeah.
and it's going to take single family construction, a period where incomes are rising and the economy has the best thing for housing would be a long, boring economic expansion. Long,
Amen.
yeah, long, boring economic expansion, not overheating the economy, just a long economic expansion.
Yeah. Boring, boring years. And I'll just add one more wrinkle if we're going to put some magic pixie dust in the ether. And that is not only new home construction continues, but let's keep building smaller and smaller homes so we can get more inside of a footprint. We can lower the price point because affordability can be got by lower prices, lower rates, higher wages. But if you actually build a product that is smaller, the price point is better. So let's put that out there as well.
Exactly. Townhomes,
Yeah.
and yeah, all of that stuff. Yep.
Well, you put out a lot of amazing stuff at Resi Club. It's amazing you're able to produce all that you do. The one that caught my attention that I'd love to riff on and have the audience see this week is the hottest and the coldest real estate market. I thought that was a very interesting article and charts that you put together. Can you share that?
Yeah, I'll share that. Let's see. Okay, here we go. Um, we used realtor.com data and their hotness score. A lower score indicates a colder, softer housing market on a relative
Got
basis. A higher score indicates a stronger market, hotter on a relative basis. The key word there is relative
it. Mhm.
because a score of 100 right now is different than a score of 100 in 2021, right?
Understood.
So
Yep.
everything's relative to the market now.
Okay.
So a market can have 100 now and not necessarily be overheating like it was in the pandemic. And a
Okay.
market that had a zero score during the pandemic could still be hotter then
Mhm.
than even a market at 100 now. So it's all relative to the market at the moment.
Okay.
And by the way, these AI images are getting so good.
Mm,
Told it hot and cold housing market, and this is what it came up with.
not
Um,
bad.
and so here we go. The Midwest, Northeast, that on a relative basis, this is the strongest part of the country. The crazy thing is that California somehow snuck right back in because California, they were hardest hit by the mortgage
Yeah.
rate, right? All those high priced homes, rates going up so quickly, people were already stretching themselves thin to buy homes there. Mortgage rates moved up so quick, and they had a bit of a pullback at the top of the market.
Hmm.
Uh, but the problem is there's an acute shortage of housing in California. So once
Yeah.
it stabilized, it was right back to same old, same old.
Yeah, I talk to agents in the Bay Area and Southern California every week, and they're telling me about some wild bidding wars going on. There's a house in the Bay Area. They got 40 offers. That was, it was a know nothing house. Same thing in Orange County. It's wild what's going on in California right now.
The one area that gets disputed the most, the people emailed me, is up here in the north, the
Hmm,
uh, Pacific Northwest. Some people
sure.
say it's hotter in their spot. Some people say it's colder.
Hmm,
There's probably a few different things going on there. And the thing is, Tacoma is different than Seattle,
for
and
sure.
there's I think there's probably just some regional variation. But I do think generally the southern part of the coast is warmer right now than the top.
I would
Uh,
agree.
the weakest part of the country right now is, and you're actually seeing a little bit of a tightening around Austin, which has been
Mm.
interesting to see the data. I actually just got the data this morning, and Austin had a positive home price print for a month over month.
Oh,
Uh, so something to watch. This Louisiana area, they've been hit hard by these insurance shocks.
that's what
And
I was guessing. Yeah.
yeah, we've seen some softness there. And then Florida is really interesting where you're going to hear a lot of headlines about Florida as housing market this year. You're going to hear a
No
lot.
doubt.
A lot of it, though, is right here in this little pocket of this Southwest. They got
Hmm.
hit by a hurricane in September 2022.
Yep.
And one thing that we can see in the data is there's a good number of damaged properties that came on the market. And so we
Exactly.
have this housing market that is very constrained by supply and demand, right?
Hmm.
Supply is relatively tight historically,
Yeah.
but you also have affordability that is very strained. And they're a bit of a tug of war, right?
Hmm.
Well, if you get a few thousand properties damaged that fall into the supply side, and you're in this very, unhealthy affordability environment, that can, kind of tilt the market the other way. And so you have that softening, and then, inventory can begin to stack. And, a part of it is the hurricane and these damaged properties. The other part is home insurance has went up a lot. The migration to Southwest Florida has slowed down because some people are leaving like uh, some other markets for those markets for affordability, and some of
Hmm.
that pandemic migration is slowed, just like it did in Austin. Actually,
Yep.
John Burns put out an interesting chart this week that shows that when the hurricane occurred, Southwest Florida went from positive migration to net decreases in migration. And then
Mm.
right then, which was kind of interesting.
Yeah, I got
Uh,
to tell you, when I looked at this map and I read this article, I don't know that I would have ever guessed Louisiana City was the coldest. I don't think I would have had that on my bingo card.
yeah, it's interesting to see these. And, some of them I don't necessarily agree with. This is realtor.com's methodology.
Mhm.
My methodology for this that I always share with people, and I think you're kind of in the same thought process as me, is actives really are
Oh,
king.
of course.
Actives, and then what is happening to prices, right? If you know
Hmm.
prices and you know actives, you know a lot about the market. And they add in some other things like their days on market calculation and
Mm.
other stuff, which, days on market is good, but
It's
I
also
don't,
distorted. I know agents across the country, and everybody's MLS is a little bit different how they count days on market or continuing days on market, and they relist, and it can be a really messy number.
yeah, exactly. And again, please keep in mind this is relative to the moment. So when you
Right.
see a market like Manchester 100, that doesn't mean prices are going up 20% there. And if you see one like down here in Louisiana, 0, that doesn't mean prices are crashing there. This market in the country is frozen in a lot of ways, or constrained, and you're not necessarily, even in the weak places, seeing prices fall fast, right? You
It
might see a little
is,
bit of give
yeah.
up.
It's fun.
But
It
the
definitely
one
is
that
the
I don't agree,
southeast. Southeast.
yeah, yeah, in their calculation, yeah. Which keep in mind, those are the parts of the country that are building.
Yeah, that's true.
Have
That's true.
new construction, and if they have supply and economics, supply and demand,
Mhm.
so I think that bit makes sense. Um, I think some of these places that are light blue, some of these places are maybe a little warmer than this methodology might suggest. Because how this methodology works is that half of the country will always be blue and half the country will always be red because it's
Correct.
relative to the moment.
Yeah. Oh,
Uh,
yes. Correct. Yep. Yeah.
And if
Interesting.
people, this story is free, anybody could see it. And a lot of my stories will have these call outs right above the chart where it says, click here to view an interactive version of the map below. You click
Mm.
right there and you'll be taken to Data Wrapper. And here you can kind of like, if you want to dig into the data, you can see
Hmm.
Tulsa, Oklahoma, their hotness score, their hotness ranks. So they're 230 out of the 300 markets, and they're the 54th largest market. So I try to give you guys a lot of interactive data.
Yeah, this is why Resi Club is a must for anybody that's following one rental at a time because you really get to see what's going on. Oh, look at my market, Fresno, California.
Yeah, so the 300 markets, you're in the top fifth of in the markets for
Hmm.
one. And okay, Fresno is the 71st largest metro. I knew it was somewhere in that 100 to 50 range.
Yeah,
Interesting.
yeah, yeah. It's a million people now.
Wow. What was
Yeah.
it like 20 years ago?
When I started buying there, it was more like 550, 550,000.
Wow. Okay. So that's why it bubbled in the 2000s.
Hmm.
The investors were right. It was just like the tech bubble. They knew that's where the growth was. They
Hmm.
nailed that part. They were just ahead of their time, ahead.
Yep.
They got there too early. And
Yeah. Yep.
mortgage products allowed it to accelerate too far.
Yeah, those last 2 years, the mortgage products were all of it. That's why I sold all my houses. I sold all my houses at the peak because I was there early. I saw what changed and people started doing bad things. And I didn't I knew it would be a bubble. I did not know it would crash 75%. That was crazy. That first house was worth 300 at the peak and 75 when it got foreclosed. That was crazy.
Yeah, that's wild.
Yeah.
Anything else you want me to share? Any of the home price forecast?
Yeah,
Any
I think
more?
if you want to flash the forecast, I think the forecasts are going to be interesting because I'll say it right here. I'll make another prediction because that's what I love to do. We're going to see a lot of adjustments down in price forecasts because I think people are going to come to realize we're going to be at 7. And I think a lot of these forecasts assumed 6.5. And we'll see what happens,
Well,
but that's
some
what
of
I think is
them
coming.
assumed like 5, 8 by the end of the year.
Right.
So,
Yeah,
these models, they all keep trying to pull mortgage rates that way,
yep,
and they've been doing it for 18 months.
correct.
Now, the interesting thing was they were doing it 18 months ago, and they thought mortgage rates would come down, and they thought prices, and affordability has just went the other way.
Yeah.
So here's the roundup that I did. This is my official roundup for the year. I will say that Zillow is 3.5 here.
Hmm.
After this ran, because I'm only doing full year forecasts, they're December to December.
Hmm.
They went up to 4.4.
Hmm.
And then this week they went to 0.8, so 1% now. So Zillow's been all over the place. They've gone up. They went up to almost 6.8 last year,
Oh,
and
wow.
then dropped down to negative for a
They
bit.
had a negative. Yeah.
We
Yeah.
slowly drifted back up and hit 4.4 a month ago, and then now 1%. So they're all over the place, and they do monthly.
Mm,
Uh, and so the average of all the ones I track is 2.38. But if you take Zillow down to 1, this is starting to get closer to 1.9.
yeah. Yeah, I don't like changing my number. I think this year is going to be flat as far as prices, plus or minus 1%, most likely plus 1%. It's part of my thesis that the housing market needs to heal itself. And 7% rates will help that, I think.
Right now, yeah, I think we're seeing a little bit of balancing in the market.
Yeah.
You finally got past a little bit of that seller strike. There was a real
Yes.
seller strike, and that kind of helped to put momentum a little bit more in
Hmm.
upward pricing. And then
Correct.
now it's like, okay, you've seen some give in there.
Yeah. Yeah. We are seeing net new listings trend in the right direction. We've seen active inventory above last year. So we will see where we're going. I think again, I'm going to put it out there. I hope rates stay at 7% at least for most of this year, because we know what happens if rates go sub 6.5. It gets wild quickly. Folks, Lance, if people wanted to get Resi Club, the 5 free articles a week, where are they going?
Google Resi Club Analytics. That's it's resiclubanalytics.com. You go there, right in the middle of the page, you'll be able to put in your email. You might need to wait a second. Sometimes a red box will pop up, but you submit it in there, you'll get the newsletter. I do also have a premium tier if you want some more analytics and data down to a regional level. And then if you want my Twitter, which is where I'm the most active, or you want to reach out with a question, you can find me at News Lambert.
Folks, you got to follow him on Twitter or X at News Lambert's where I found him. It's where I invited him to the channel and he said yes. And if you are detail oriented like I am and you have a buy box, you want to get the data down to the regional level, get the pro membership. It is worth it. Lance, you're amazing. Have a good week.
Thank you. Bye.
Mhm.